Good morning, everyone. Thank you for joining us. This is our quarterly asset allocation webinar. The main purpose or use of the webinar is for you to be able to ask us questions about how we are putting portfolios together. And we at VanEck think asset allocation is the most important conversation to be having. So we have some table setting that we need to do. And without further ado, I'm going to turn it over to my colleague, Pat Schramm.
Great, thanks, Jan. Good morning, everybody. My name is Pat Schramm. I lead our RIA National Accounts team here at VanEck. I'm pleased to be joined today by our expert panel, our CEO, Jan van Eck, who we just heard from, our head of Multi-Asset Solutions, Dave Schassler, and one of our chief strategists, Charlie Cameron. The purpose of these quarterly webinars is really to deliver timely insights straight from our Asset Allocation Committee. As Jan mentioned, you hear from us a lot. You maybe see us on TV. We really want to take the opportunity to have a direct conversation with our allocators, with our investors, with our clients, and really dig into some of the themes and trends and some of the guiding principles that we use to manage our model portfolios, and as well as the guiding principles we use here at VanEck to build investable solutions and innovate around product. We approach the markets through VanEck's really unique macroeconomic lens, a perspective that we've built over our 70-year history of innovation. And our long-term views are really informed by three key driving principles: government spending and fiscal policy, shifts in monetary policy, and rapid technological change. These are the foundational building blocks. And by using history as a guide, these elements help us shape the investable products we create, as well as how we manage our model portfolios, which we're going to talk a lot about today. And we do this with a very long-term forward-looking orientation. So in today's discussion, you're going to hear about our outlook, our current positioning across several of our key themes. If you've listened to any of our commentary or read any of it recently, they're going to sound fairly familiar, but there is a lot evolving within these themes, and we're going to catch you up on our current views and outlook, again, with a very long-term forward-looking lens. And those are de-dollarization and monetary debasement, right? As pioneers in gold and real assets investing, we're going to discuss some of the renewed excitement we've seen around tangible real assets like gold, silver, and Bitcoin. AI continues to be a generational shift. We're going to cover where we are in the cycle. We have a three-phase schematic that we use to really think about how to invest in this cycle and where to invest and how to inform investors in terms of where we may be and how to position portfolios. And of course, fiscal and monetary policy, right? We're going to talk about debt, deficits, inflation, geopolitics. All of these things are really contributing to a year full of risks and opportunities. And included in this discussion, you're going to hear about how we're managing these risks and allocating to the opportunities that we're thinking about across our model portfolio suite. We're going to leave some time at the end for Q&A, so please submit your questions into the chat at any time during today's discussion. We find the Q&A to be the most fruitful part of the discussion, and we really welcome your feedback and your thoughts. One appeal from the audience: if you don't have a question, I'd still love to hear from you and get your input on the 2026 acronym of the year. We had tariffs in the taco trade in 2025, which was short for Trump always chickens out. It was buy the dip after Liberation Day. He's going to come to the table and negotiate. It turned out to be a fairly fruitful acronym. 2 weeks into the year, I think we might have a front runner already for 2026 acronym of the year: FAFO, F-A-F-O, or as the kids say, fool around and find out, or fuss around and find out, right? We're quickly learning this policy not only applies to dictators holding oil reserves and nuclear weapons, but also Federal Reserve chairmen and near frozen resource-rich countries in the North. It's a lesson I've been unsuccessfully trying to teach my children for 12 years, but we're learning very quickly that this is embedded in political and geopolitical policy. So all joking aside, please submit your questions and your feedback. If you have any thoughts on 2026 acronym of the year, I'd love to hear it. I'll come back in at the end and talk about how to allocate to the ideas you hear about today and where to find some more information on our outlook and our viewpoints. But with that, I'm going to turn it over to the team to kick us off.
Great. Well, I've just shared some of the background slides on the firm, so we don't need to walk through those. So without further ado, I'm going to turn it over to David Schassler, who's going to talk about, all right, how do we foundationally think about putting portfolios together? So, Mr. Schassler.
Awesome. Yeah, let's think about this as the prerequisite. How do we think about the world through the lens of investing? Understand this, and the rest of the presentation is going to make a lot more sense. So, first and foremost, Jan led off with this. Diversification for us is everything. We run diversified portfolios everywhere. We want to be prepared for whatever the world throws at us. There's 4 major economic regimes: high growth, low growth, high inflation, low inflation. We want a tool in the toolbox for every one of those environments, not the environment that we hope for, not the environment that we expect, but regardless of what the world throws at us, we want something on that side of that trade. So when you look at our solutions, you're going to see a lot of diversification by design because we want consistent, repeatable performance throughout the cycle. Moving on. So theme identification framework. We are a macro thematic shop. We strongly believe that you need exposure to key critical themes to drive portfolio performance. So structural drivers, we're looking to identify the forces shaping markets to help us drive performance. Now, we know what a lot of those big themes are. That's what we're going to talk about today. So everything from AI to fiscal dominance and debt and deficits and gold and resources, all of that, we're going to get into it. Durability. We are not looking for quick hits on themes. We're looking for themes that are going to last for an extended period of time that we can play. So think medium to long-term themes. And then exposure design. We are looking to exploit and play themes many different ways. So if it's in AI, for example, we're going to play compute, but then we're going to play how are you actually going to build out the data centers? How are you actually going to power the data centers? How are you going to pay for it? So really exploiting the theme across the capital structure. So moving on, this gives a peek at some of our biggest structural themes. I'll just hit these quickly and we'll keep it moving. But technological disruption, yes, we're talking about AI. Yes, we're talking about automation. Yes, we believe it's going to change the world and it's going to happen faster than people expect it to. That's a theme we've been playing for some time with a lot of success. Real assets, old world assets, building the new world, debasement protection. How are we going to pay for it? Debasement is the strategy. It's not an accident that gold's a top performing asset. And then there's implications on fixed income. Rising, we think that there's going to be continued steepening. So we've been playing that. Differentiated ways to gain exposure and increase yield without taking more risks. Things like securitized credit. We're talking about CLOs. Ratings migration. We're talking about fallen angels. Risk anchor, lots of treasuries. So this is how we gain exposure. And then the last process chart that we're going to talk on before we jump into the fun stuff is our investment process. Our investment process is quantitatively driven. That relates to portfolio construction and risk management. That's a really kind of complex way to say that it's disciplined and it's repeatable. That's what we're all about, understanding the mechanics behind our portfolio construction and risk management process. Once you understand that, you can really start to understand the way that we view the world and the way we become more aggressive when we get trading opportunities or more cautious when risk swells up.
That it?
That's it. Yeah, let's jump into the next section.
Yeah, I mean, I think that the key is not to fall too in love with themes that are working, right? And that's what this quantitative process protects us. And also, we don't want to surprise clients with big performance differences from the mainstream indices, right? So we put these thematics together with this consciousness of not wanting to be too far about what clients' expectations are. Okay, now I'm going to grab the mic a little bit with David and Charlie, our investment committee colleague, to talk about some recent developments really quickly that happened that are affecting the fourth quarter performance. So, David, why don't you talk to this first slide here?
Yeah, this level sets up the following slides here. AI, I spoke about it a second ago, but from very, very simply, we don't think it's overhyped. We think it's going to change the world. It's going to drive productivity. That productivity is going to drive economic growth. It's going to shake out in 3 phases. Phase 1 was the build. You're going to see the situation on the ground is largely going to change, but there's a lot of CapEx. And the assets go to where the scarcities are. So all the assets went to compute and to energy. And that's why you saw a huge bull market in these assets. But we're transitioning to phase 2. Phase 2 is the adopt. That's investors looking around the table and saying, when do we get paid? How do you take this technology, incorporate into your business to drive ROI? This is the part where you start to see output per employee increase, marginal labor cost decrease, margins improve. So most companies, and each company is in different phases at different times, but generally speaking, the market's moving from phase 1 to phase 2. Phase 3 is when it gets wild. The world changes. You're taking AI, which is the brain, the body, which is robotics, combining those two together to drive this digital world into the physical world and actually fully realize the benefits of productivity gains, productivity growth. That's the end goal. We think it happens faster than people expect, but maybe not fast enough for the markets to like. So in regards to that, you're going to see some volatility. Let's move to the next chart. So Jan, I'll let you take a stab at this one first.
Yeah, I mean, I think that, as David said, the economy looks kind of interesting. When you look at last year, there wasn't a lot of employment growth, but our GDP prints, second, third quarter, and what the Fed, Atlanta Fed is now predicting for the fourth quarter of real, growth at 4% or higher, is pretty interesting. And, that is concentrated in the AI capital data center build out, but so that's not necessarily a bad thing. But it will be very interesting to see if that has implications. So that's one of the facts on the ground that I think we need to talk about. I don't know if you, Charlie or David, had any other comments on this.
The only thing I would add is, GDP is C plus I plus G, right? And plus net exports. And our trade deficit is contracted quite a bit with tariffs. So what was a very negative net export number for us is declined dramatically. So that's leading to an uptick in GDP.
Do you think that's persistent, Charlie? I saw that was in the Atlanta Fed numbers.
I'm sorry, I didn't get that, Jan.
So part of the reason the Atlanta Fed's GDP estimate for the fourth quarter went from like 2% to 4% was because net exports became, basically a contributor to that GDP number. Do you think that's continues?
I think part of it was a government shutdown, but I mean, again, it was the trade deficit went back to where it was in 2009. So
Right.
a dramatic drop in the trade deficit.
Do you think that continues into 26?
I would think if growth picks up a little bit, you'd probably see a little more imports here. But the trend is definitely, obviously, reshoring and onshoring will, should affect the trade deficit in a positive way.
All right. I guess
You want to take this one?
More of the same, right, David? So any additional comments here? It's just the magnitude, obviously, is of the CapEx is really worth noting.
The new world doesn't happen without the old world. Lots of picks and shovels, lots of resources. You saw huge demand for data centers. Expect that to broaden out, because how are we going to power this? It's just going to broaden out, especially when we factor in reshoring. So hugely positive, but expect a broadening from here.
Yeah, before we leave this, I would say that we at VanEck were playing the AI trade last year in what we call AI 2.0, with nuclear energy being a big piece of that. And nuclear offers, and Meta just announced a deal last week on this, what I call the QR code unlock, which is not just quantity of electricity, but also reliability, because data centers need kind of the highest level of uptime that's commercially available. That's true for other sectors of the economy, like military, that are leaning into nuclear. But I just wanted to share that kind of comment that nuclear was one of the ways to implement this trade.
Military exposure. So last Tuesday within a wealth builder, we increased exposure, or we actually took dedicated exposure to aerospace and defense. Why? Really twofold. The first reason, this is adoption. So we spoke about phase 1, which is the build. Phase 2 is the adoption. You're seeing a critical shift in warfare. Every time you have a major war, whoever stays at the forefront of technology seems to have the advantage. Not surprisingly, you've seen a structural increase in global military spending. That's accelerating. And a lot of that has to do with increased geopolitical risk. So you've got dual catalysts, right? The first catalyst is technology, which forces adoption and forces investment, which you're clearly seeing that. And the second part is unfortunately increased geopolitical risk, which we're seeing more and more of these days. You put those two together, and we're very bullish on military spending, both domestically and abroad. So on Tuesday, we took a position within Wealth Builder for defense spending, and then on Wednesday, Trump came out through Truth Social and reported that he's planning on proposing an increasing of the military budget from 1 trillion to 1.5 trillion in 2027. So all roads leading to more military spend, more adoption of the technology, and we're there.
Charlie, what's going on with silver?
David, I know you wanted to start with silver here. It's a couple points you have on there.
Yeah, listen, this is twofold. So you have the embedded scarcity. The embedded scarcity is the same impact that's driving gold prices. So you have that. That's a key piece of it. But then you have the industrial usage as well. Now, when you look out, there's more and more demand for silver through the components that are driving this huge innovation CapEx cycle. So you've got both structural supply demand forces, and you also have the piece that's coming from it as well for scarcity protection, similar to the gold trade, just more risky. So Charlie, what do you think?
Yeah, I mean, silver demand has outstripped supply for the fourth year in a row. It is a small market, so there is a speculative element. Silver doesn't have the central bank demand that gold does. But there is a speculative element to it. There's been a lot of call buying. That being said, BCOM rebalanced at the end of this year, of the end of last year, and sold $5.5 billion worth of silver the beginning of this year. And that was all absorbed, and obviously silver made new high prices today. So there is definitely meaningful buying in the market.
It's an industrial, or is it store of value?
I think it's a combination. I think it's speculative industrial. I think it's a combination. I mean, silver is deemed a critical metal by the U.S. Silver inventories in China have disappeared basically. So it's a combination of it, I think, of all what we talked about.
Got it. Well, as part of these themes, just wanted to show this chart on nuclear. In my quarterly outlook coming into the fourth quarter, I pointed out that no matter how much we like nuclear, there are risks to this thematic. The biggest risk is obviously that it takes years for a nuclear facility, whether an SMR or a big one, a gigawatt plus facility to get online. And so the question is, would investors ever doubt that? They still, I would say, haven't doubted it, but we did feel like some of the valuations were at nosebleed territories, which gives us a better buying opportunity coming into 2026. And then as we close out the AI section, David, one last slide.
Yeah, and let me just give two more comments on silver nuclear. Price performance has actually been spectacular, and throughout the year, with nuclear and then more recently with silver, we've taken profits. So it's not that we're not bullish on it. It's just that when prices completely decouple to the upside in magnitudes that we've seen, it's oftentimes a good time to put a little bit of money in your pocket, and we've certainly been active in that. The bill behind AI, the takeaway and the punchline for this is really simple. The new world doesn't happen without the old world. We've been in one heck of a bull market in real assets, but I think it's a stealth bull market. And the reason it's a stealth bull market is because people have been riding NVIDIA to the moon, so why own anything else? Now things are getting harder on technology side. Competition's increasing. And you look around, you see where's the bottleneck? The new world doesn't happen without the old world. Infrastructure is a key piece there. We're looking at likely a 10 to 20-year cycle in regards to investment. If you think about reshoring, you think about the build out for AI, we're really bullish. And this is what this has shown. It's a bull market. Gold's the ultimate store of value asset. This is how are we going to pay for it? We've been structurally overspending in this country for decades. Now we're in a period we've switched from what, at least I'd argue, I don't want to put other words in other people's mouths, but from monetary dominance to fiscal dominance. Falling interest rate allowed us to just completely splurge on debt. Was great until it isn't, and then when interest rates hit the bottom of the range, and then inflation pushes us off a little bit, we switch from monetary dominance to fiscal dominance, and the dollar's under pressure. Right? It's not just a dollar versus. It's not a relative currency play. It's a debasement issue. If I could pay back yesterday's debts with dollars that are worth less today through debasement, and then I could think about how am I going to spend in the future? Think about AI, infrastructure build out, reshoring. Think about that as critical because we're in a global race. And in that global race, you can't lose. So the setup here is really simple. Gold is the ultimate store of value asset. It's always been that. It's more than just a commodity. It's an essential part of anybody's asset allocation.
Well, in my outlooks, I like to talk about, what 2026 will look like from the perspective of 2035. And when I send it out, I always have a colleague saying, Jan, you have a typo. You can't be meaning 9 years out. And I do mean 9 years out because I think it's sort of like a perspective of the Earth from the moon. When we look back at this, in a decade, what are some of the just huge macro, I'll call them magnet forces that are pulling? And one is our fiscal deficit. And so it didn't, I would argue, have much of an impact on the markets in 2025, but that doesn't mean it's not one of the risks out there that you should consider when it comes to asset allocation. Gold is obviously a hedge to that, to the fiscal issue. But I want to look at a yardstick here, which is longer-term interest rates. Now, this is a little bit of a mixed-up chart. In blue, you can see the 10-year interest rates. And last year, they were basically pretty well behaved, which I think shows that the U.S. made progress, and I talk about this in my quarterly outlook, towards getting in a better spot of fiscal deficit as a percent of GDP. I'm expecting 5.5%-ish for this fiscal year that ends at the end of September. You can see that's the 10-year reflected better kind of fiscal situation. A lot depends on tariff revenues. But anyway, so that's what the 10-year showed in the United States. I'll call this the KPI for our Secretary of the Treasury. But that didn't mean, and Charlie keeps pointing this out, that the rest of the world or the markets are very conscious of interest rates going up, meaning in other countries having debt problems. So not the 10-year, but the 30-year interest rate in Japan is really reflecting that country's debt issues. So you have to stay vigilant. It was a topic of conversation in global markets for 2025, and it's a risk for portfolios. So I don't think you can do an outlook without talking about it. I simply say that we're in the 10-year trend of gold regaining its status as the leading global currency. This one chart shows that gold holdings have passed U.S. Treasury holdings at non-U.S. central banks. This obviously reflects the price increase in gold to a certain extent, but there is a lot of buying of gold globally. And every time the U.S. takes an action, militarily or sanctions or otherwise, that affects the world, just because we don't like the way the world is, the rest of the world says, that's fine, give me more gold. And so that's what's been happening. Again, just some data points worth noting. Services inflation has fallen pretty dramatically here in the United States. That was one of the parts of inflation that I personally worried about the most, because services can be hard to escape. So, as I said, things looking, not to say the risks have disappeared here, but things are looking a little bit better. And then last, just when one looks at the asset allocation framework, and I think this is our last chart, next to last chart in this section, the Bitcoin halving cycle. So basically, Bitcoin has a very bad performance every 4 years, partially related to the fact that the amount of Bitcoin given to Bitcoin miners who run the network, they get half every 4 years. So that's kind of a tough economic situation that tends to affect the markets. The Bitcoin bear market, if you want to call it that, came a year earlier. So I think that's something really worth noting. So this whole 4-year cycle, it broke last year. Let's just call it that. Now, whether that continues or not, But the good news is the way we run our asset allocation and David's group works, its quantitative metrics, is that we can adjust to a bear market moving earlier than it has in history, and our signals kind of track that kind of stuff. But one can't kind of review last year without pointing that out because it's pretty dramatic for that asset, obviously. David, you want to speak to this?
Yeah, this is a simple but powerful chart. And this kind of just, I think, tightens up and drives everything that we've been saying. We are in a new structural regime. That's how we view it. And it's a regime that has a few hallmarks in it. The first is that we are in a period of financial accountability. During a period of financial accountability, debt matters, deficits matter. That's what you're seeing in all the charts, really, we showed, whether gold's outperforming or interest rates are rising for people that have too much debt. So we're in a period of financial accountability that favors assets with embedded scarcity. The key assets with embedded scarcity, you're talking about gold, you're talking about Bitcoin, but other real assets as well, just less so. We're also in a period defined by disruptive technology. And that disruptive technology is driving not only CapEx, but it's going to drive productivity. That productivity can drive economic growth, and it's going to change the world along the way. And then the last part, this is a super aggressive CapEx cycle favoring old world assets as we build the new world with old world assets. So that's what you're seeing very, very clearly in performance. So if you're not running a well-diversified portfolio and been leaning exclusively on technology like many people have, we push you really aggressively to rethink that and just run a well-balanced, diversified portfolio. And you're seeing the benefits of that here in this chart.
Great. So, David, I'm going to just remind the audience that the intent was to have a dialogue. So get your fingers loose and put your questions in the chat. We're just going to jump into the last section. I'm going to jump over this slide, David, and just have you touch on how we implement these different ideas.
Yeah, this is a continuation of the prerequisite that we started on and how we think about models, how we think about investing. Just to make this piece of the section make more sense, we've got two types of models. We've got total portfolio solutions like Wealth Builder or all-in asset allocation. So when I'm telling people that, we think that investors should have at least 5% in gold, reference Wealth Builder as that starting point. Income Builder, it's a total fixed income solution. And then we've got portfolio enhancement models. What does that mean? That means if that your core is intact, but you want exposure to the themes and the diversifiers that we spoke about before, that's how these come into play, because you can take any portfolio and bolt on anywhere from 15 to 25% of these portfolio enhancement models, get increased diversification, a broader opportunity set. And if you allocate from the right segments of risk, you shouldn't increase your risk materially in the portfolio. It should basically be risk neutral with a broader opportunity set. If we go to the next chart here, performance has been strong. We've been blessed with strong performance because the winds been in our back thematically. But more importantly, and I keep hitting this and I'm going to continue to do it, this is the regime. Post-COVID world favors diversification. It favors differentiated assets. It favors the themes that we're speaking about, but it also favors assets with embedded scarcity and real assets. And that's a big, big driver of our performance. You're seeing material outperformance across the board and consistent outperformance simply because we're leaning to the right themes in the right proportions and running very, very diversified portfolios.
I'm going to point out that a lot of the numbers, obviously the 1 year are green, which is great. 3 month, we talked before about some of the themes that we had talked about having headwinds in the fourth quarter, and you can kind of see that here across the board, but that those headwinds are kind of within bands that should be completely acceptable, hopefully, to you and clients. So keep going, David.
And a lot of that performance, any drawdowns that we experienced into December have significantly reversed recently. So that's what you'd expect. We constrain performance, and the idea is really simple. We want to deliver a performance in line with the client's expectations. Doesn't mean we're always going to outperform, but we do want to deliver within expectations. And now I'm going to show a couple charts on contributors to performance. So what you're seeing here is average weight in blue, total return, and contribution to return. I'm going to keep banging the same drum here when it comes to diversification. What you're seeing here is in 2025, equities worked, Fixed income worked a little bit. Real assets worked a lot. Digital assets didn't work well. But really interestingly, we had a lot less exposure to real assets than fixed income, but fixed income, and you could see, but real assets, the green, the contribution performance from a reasonable size, but small allocation of real assets relative to stocks and bonds was a big driver of performance. And then Bitcoin, which was an underperforming asset relative to everything else, detracted very, very little. And this speaks to how we allocate risk, how we lean into diversification, and what we call prudent exposures. And if we move to the next,
that's an amazing slide.
and that's the same thing on the next one. So this one here is, we're just extending out the timeline from the inception of Wealth Builder. And what this is showing is that diversification has paid off. It's the same idea that I just showed you before, but because we've got more time on our side, it's being magnified. And I'm going to keep banging the same drum over and over and over again. We're in a structurally different regime than we were pre-COVID. We're in a regime that favors diversification. That's what you're seeing here. Reasonable but moderate allocations to what people generally don't allocate to, things like real assets, things like digital assets, are really having a strong impact on our portfolio performance. But our total portfolio risk is very, very much in line. And this continues to speak to the benefits of having these differentiated asset classes within your portfolio. And then I've got one more. It's just the winning and lagging theme. So gold's done great. Everybody knows it. So this is contribution to performance. Now, gold exposure wasn't huge at the total Wealth Builder asset allocation level, but it sure as heck contributed a lot to performance because it's had one big run. Gold being a top performing asset is not an accident. It's information. That's the market speaking to you, clearly identifying a risk and rewarding investors for investing in scarcity. Semiconductors was all about that phase one build out. The same thing with uranium and nuclear. That's where the scarcity was. We absolutely think nuclear is part of the long-term solution. May have gotten over its skis. We've taken profits throughout the time on it, but still it's an essential component. And then things that haven't worked as well. India's been struggling. Valuations were high, growth expectations were high, and it's been a bit bumpier. We had some exposure to, we'll call it broad diversified natural resource equities. We exited out, went into more diversified real assets, and that trade really paid off. And BDCs have struggled. Jan, do you want to talk about business development companies and why they've struggled?
Well, I really want to turn it over to the questions, but I would say that very bullish things that lagged a little bit. So I'll leave it at that. And if we follow up on a question, I can share more.
Great. Yeah, well, those are my final points on the asset allocation and the themes. And then before we kick into Q&A, I'm going to drive home the 3 points that kind of consolidate everything from what we spoke about. Differentiation points and things that we think are super important for all investors, either if you invest with us or not. Prudent thematic exposure. I emphasize prudent because having reasonable exposure to key structural themes we think is absolutely essential. Broad diversification, a must-have always, specifically in this regime. And then you need portfolio discipline. And that's absolutely essential. And that's something that we're delivering on.
Great.
So let's jump into Q&A.
Yeah, I'm going to start sharing some of the questions here. So, okay, I guess we have a question. You can answer that. I guess I'm going to combine two questions, David. One is how would a shift in the debasement regime? Sorry, I'm going to the wrong. Let me do two. There we go. Okay. How would a shift in the debasement regime change portfolio structure and asset allocation? Related to that, our real assets allocation strategy is near 1 year and 5 year highs. Is it a bad time to buy? Now, I don't want to answer the question for you, but I would imagine that this portfolio would change, right? If you had a different view of what regime we were in. So let me turn it over to you on that.
Yeah, the first part of that is about debasement. Now,
actually, let me interrupt.
Sure.
For those of people who aren't familiar, our real assets portfolio is kind of an all-in-one solution. If you don't want to pick gold or pick silver or pick a particular asset and you want a diversified approach that changes over time, this is kind of your all-in-one solution, and it's available in an ETF or in a model format. So, sorry, David.
Yeah, no, thank you for that. That definitely helps with clarification. So Real assets and the way we've structured this portfolio, think about this is I think this is the simplest way I could describe it. 2/3 old world building the new world, key critical inputs. It could be direct from infrastructure development, but to the underlying raw materials needed to build out the new world. There's embedded scarcity there, but there's also utility. Now, that's a key part, especially as we start to think about the CapEx cycle, 10 to 20 years out, which we think is the logjam here, holding the new world back. So we think that's absolutely critical. That being said, how are we going to pay for it? And that's where the debasement protection comes from. Increased geopolitical risk combined with constant printing, because we strongly believe we're in a period of fiscal dominance. Now, that's how we're set up. Now, the part about change, as the world evolves, we're going to adapt our allocations over time. So if debasement becomes less of an issue or gold becomes overvalued, we will structurally reduce exposures over time using our investment process. And we have. We've taken a lot of profits in gold throughout the years. Even though we're super bullish on it, we continue to take profits in gold, given price movements and our objective of running very, very well diversified portfolios first and foremost.
Well, let me push on that. Taking profits in a bull market is different than being in a different regime. How low could you see the gold allocation be in this model?
Gold's an interesting one because it does two things. It's our portfolio shock absorbers. It's there as a really nice portfolio hedge, usually zigs when other things zag. And during normalized periods, it has very muted volatility profile. In the regime that we're talking about now, because the wind certainly at its back structurally, our hedge is our top performing asset, and it's becoming more volatile than it was historically. I could certainly see a range, getting down to 15% in gold on the bottom side, but we're all the way up at the top now. And keep in mind, we entered this bull market at the top of the range. If we didn't systematically and structurally reduce positioning, we'd be talking to you about a gold fund. That's not what we are. We are a diversified asset allocation as it relates to real assets. And we've been systematically reducing gold, taking profits, redeploying those profits to other segments within real assets. But those are performing really well as well. So this certainly is a robust bull market across the spectrum in real asset investing.
Boy, a lot of questions. Here's a good one. Well, there are a lot of good ones, but I think it goes to how this might change in a totally different era. So do you see nuclear as a long-term holding? Is it mostly the growth in data centers globally that powers this trade? It's corrected off the high. Would you add here? If you're doing your own asset allocation, I definitely got more bullish myself in our quarterly outlook. But David, what about nuclear? I don't know. Could the trend extend too much, or is there a regime where you could see it not being in the portfolio?
So first off, you said it perfectly up front when we started the presentation today. We're not married to any individual theme. So let's start with that. We have exited themes, specifically exited and reduced themes when the market's telling us that although we may believe we're right, the timing is off on a theme. So for example, we've reduced exposure to themes, things like India that we spoke about before, which was one of the biggest detractors. On the opposite side of this, we've been reducing exposure to NLR simply because it's performed so well over time. Now, the correction in NLR brings it back to the point of makes it more interesting, makes us more comfortable with the exposure. But it's not such an extreme correction that we're rushing out into buying it. So we're very comfortable with how much exposure that we have to nuclear right now. And simply because we think nuclear is absolutely part of the future. We think it's here to stay. Whoever has the most durable, cost-efficient source of energy wins, period. It's very hard to compete against. And given existing technologies, we think that nuclear is absolutely part of that.
How often do you rebalance the ETFs?
Yeah, so RAX, for example, RAX is a real asset ETF that invests in our diversified real asset solutions. So that ETF is not based off a set rebalancing schedule. So what we will do is we observe the allocations over time, and then we will make adjustments when there's something to do. The models are a bit differently. So the models, what we will do is we will use a quarterly rebalancing to move positions along over time, but we will also opportunistically rebalance, meaning if something happens in the market that's worth taking action on, we're going to take action. So buying Bitcoin in November 21st, when Bitcoin was in the low 80s. That was a time to add exposure. So we will opportunistically take positions intra-quarter, but for the most part, we are going to push with a quarterly rebalance.
But when you look at like our version of 60/40, which is Wealth Builder, which I've pulled up here, David, how often are you making changes in that portfolio?
Typically, this will work off a quarterly rebalancing schedule unless there's action in the market that will force us off of that. So if something happens that we view as an opportunity or a risk that needs to be mitigated between the quarterly rebalance, we will do so. However, without that being done, we will move to the quarterly rebalance. So the answer is both.
Yeah, but mainly quarterly.
Correct.
Got a question about quantum. So you could see that nestled in this overall as a thematic with a 0.6% weighting. How do you think about that?
Quantum computing is super interesting, and it's getting louder and louder and louder, specifically as it relates to Bitcoin and the risks around Bitcoin related to quantum computing. The thought here is really simple. It's an interesting technology. If and when they get it right, it has the ability and potential to be wildly disruptive and really push us forward from a technology perspective, also introducing significant risks. There's a few key players there. We have diversified exposure to it. It's another quiver in our cap, another way that we're playing the broadening out of tech and AI beyond just the Mag 7. And I should say this as well. We are long technology. We are overweight technology as a sector, but we're underweight the Mag stocks. And we've been positioned that way for some time, and we're going to continue to be so. We're expecting a broadening out.
Okay. Yeah, a lot of questions. I think you answered the one on defense, which is basically that we added defense as a thematic ETF just over the last week or so, right? Do I have that correct?
Correct. It went into
great.
Wealth Builder on Tuesday, some of the other models on Wednesday or Thursday, but we've been increasing exposure. The ranges are really anywhere from 1.5% on an all-in portfolio to some of the more targeted solutions up to 4%.
Okay. Credit risk. We haven't talked about that a lot. I did talk about it a little bit I definitely talked about my quarterly outlook. So in the fourth quarter, there are a lot of bad headlines about private credit. I basically think that they were overdone given the strength of household balance sheets and corporate balance sheets. Unless there's and given the fact that the bad headlines were related to specific frauds at specific companies, I think BDCs are pretty attractive here. This shows that they're trading below 1, which means they're trading at a discount to book value. Now, I will say they're being pressured by the prospect of lower interest rates, number one, and they can trade at much lower discounts. But I really like their daily liquidity, and so with a 9% yield on BDCs, I think they're pretty attractive. So we've kept them in these portfolios. There's another question relating to India. I would just say the good news, the market underperformed last year. It was up for, I think, the 10th year in a row, but it underperformed other emerging markets and other international equity indices. I think there was a little bit of a hangover over the elections that they had in 24, but they did a lot of good reforms in 25 in their bankruptcy laws and their labor laws. So they continue to be bullish. There's a lot of technology, risk to India in terms of their outsourced, stuff that can be done better through AI, but they're also leaning into a lot of AI solutions. So, long term, India is projected to be the size of Europe in 10 years. It's a pro-equity culture and a pro-business government policies. So over any short-term period, we don't know, but that's kind of my shorter version on India enthusiasm. And again, if it's underperforming, to me, that's a time to buy. Kind of in my outlook. There's a very complicated question. I'm going to give you something. I guess, David, we spent a lot of this commentary on AI. How do you know, kind of, if there's signs for a bubble?
Yeah. So here, I think let's just first start by grounding it. Is this a disruptive technology, general purpose technology that's literally going to change things? Is it going to drive productivity? Is that productivity going to drive economic growth? So is it overhyped? We don't think so at all. We think the technology will completely deliver on expectations. So it's grounded in reality. That doesn't mean the market won't get ahead of itself. I just don't think we're there yet. And when we are there, you won't be questioning if we're there. You'll know we're there. And the mere fact that we're having this conversation about that tells me that we're not there. It's going to move and it's going to get harder. Silicon Valley is going to find out what it's like to compete directly with China for the first time. It's going to get tougher here. Competition is going to get harder, and investors are going to demand ROI. We're not saying you don't make money in technology. We're just kind of saying it's not going to be as easy as it was in 2025 to make money in 2026. So the theme is evolving as expected. Do I think we'll end up in bubble territory? I think so, but we're not there yet.
There's a question for me that I'm going to give Charlie. What are your views on financial repression a la post-World War II, and are we entering into a similar situation due to the U.S. debt load relative to after World War II? I see no choice for the administration other than financial repression to get out of this situation. Thank you, John.
I mean, that's kind of the inflation gold story too. So do you get out of it by not, cutting Social Security? Do you get out of it by having 3 or 4% inflation instead of 2%? That being said, I mean, this government is still, it's still a pro-growth government, right? So we really have fiscal QE going on this year, right? So David mentioned defense spending, which is up 50%, will be 5% of GDP. You're trying to cap interest rates on credit cards, right? So that's, again, fiscal QE. They bought mortgage bonds to lower interest rates there. So this government this year, I think, is really going to be pro growth and trying to drive prices lower. And I think that's really, it's not going to be a monetary issue this year. I think it's going to be much more of a fiscal issue this year.
Okay, another question. So if you like your existing portfolio, I would say, but want to just take our thematics, we have a strategy called Select Opportunities. But there's a question, I think, relating to that, David, from Rosario, which is, what percent would you take out of I'll call it vanilla 60/40 portfolio and allocate to something like Select Opportunities?
Yeah, thank you. So for Select Opportunities, I would carve out 20%. I think 20%, first off, what is Select Opportunities? Select Opportunities is a diversified portfolio or diversified model of exposure to these key themes. But because these themes are so diversified, it is a diversified portfolio in its own right. It's just non-tethered to a benchmark. So when you invest in Select Opportunities, you're getting exposure to the AI evolution, phase 1, phase 2, phase 3, where those scarcities are, where the transformation is, where the beneficiaries are. So that's a huge piece of it. But you've got old world building new world, which a lot of those cyclical, industrial driven real assets, big piece of it. And then you've got debasement protection in a meaningful way with exposure to gold bullion. And you also have it through exposure to Bitcoin. So all in, if you take that and you carve it from both equities and fixed income, I would take more from equities and fixed income, but take it from there and you match volatility to volatility. Think about it as a 20% allocation within your portfolio. You do that and you hopefully would be risk neutral, but increase your opportunity set and have a much more optimal portfolio in our view.
Okay, I want to respect people's time. There are a couple open questions I'm going to try to run through, but if you have a last question, please enter it now. So what is the ETF ticker? Surinder asks for the all-in-one current asset, real assets portfolio, and the ticker for that is RAAX. So RAAX is active. There's a follow-up to that, as David described his allocations and methodology before. Wealth Builder, the overall portfolio, is not available in an ETF right now, just for clarification. there was a question about the gold silver allocation in real assets. David, I guess you don't have a separate silver sleeve. Is that correct?
We have exposure to silver and other precious metals through exposure to the underlying commodities. So if you buy real assets, if you buy RACs, or one of the models that have diversified real assets within it, through our commodity allocation, you're getting a significant and material allocation to gold and precious metals as well. So it's certainly there.
Got it. Sorry. So I pulled up the slide. There is a separate VanEck ETF that you allocate to that has a direct silver allocation.
Correct. It's so in PIT, for example, it has about 30% exposure to assets to precious metals. So between gold, silver, platinum, et cetera. So you have a hearty allocation to these metals in there, and that's been a big beneficiary of this portfolio.
Got it. Okay, Charlie, maybe you have an answer to Jennifer's last question here. Do you see a coming wave of acquisitions or mergers among smaller industrials?
I mean, again, we've seen it in the resource space, obviously. You've definitely seen it in the energy space for us. And now you're actually seeing it in we had no one's asked about copper, but you're certainly seeing it in the copper space. You've seen one big acquisition and potentially another one now, Rio Tinto buying Glencore, which will end up being the largest global mining company if it goes through. So you're definitely seeing it. These companies all want to be larger. They want to make a difference because the Mag 7, the size of them, the $4 and $5 trillion companies, $100 billion company now is not big anymore. So these companies all want to be larger. And I think that you're going to see that, I think, across industries, to be honest with you.
Great. Pat, you want to bring us home?
Sure, absolutely. Sorry, just trying to get off mute. All right, so the great news is if you didn't get a chance to write everything down, we have an easy button for you. Head over to vaneck.com/model portfolios. This is where you can find all of these ideas embedded throughout the models that we just discussed today, some of the single ticker solutions for a more targeted approach to some of these themes, as well as our research and our thought capital, the team you heard from today, as well as the rest of the teams here at VanEck that contribute to the views that you heard today are all actively posting on our website. You can subscribe to both the perspectives as well as the model portfolios. Maybe just to go back a slide, if you don't mind, Jan, to 40, 41, and 42, just to recap the core models that we talked about today. And I know there were some questions about how and where to allocate to these. Wealth Builder, as you see up in the screen, this comes in 3 risk profiles: conservative, moderate, and aggressive, right? So this is our answer to 60-40, 70-30, 80-20. And this is your total portfolio solution, right? All of the themes that you heard about today are embedded and risk managed into this portfolio. This is a diversified solution. If you are comfortable and interested in allocating to Bitcoin, that's the Wealth Builder Plus model. Select opportunities was really about what we talked about today. This is our highest conviction calls, stripped out of Wealth Builder, are effectively just the alpha pieces in a concentrated but still risk managed portfolio. And as Dave and Jan both mentioned, typically we see this allocation as a satellite piece, as a complement in the 10 to 25% range. Call it an average of 50 to 20% range, typically funded through equities. Real assets, which we talked a lot about today, Jan mentioned it, it's available in a model as well as an ETF ticker RACs, model portfolio real assets allocation strategy, all weather, right? The idea with real assets is to own this structurally over the cycle, right? Whether the inflation and growth regime is high or low or trending in either way. We have income assets, we've got resource assets, and we've got financial assets to act as a hedge, as well as an upside capture mechanism through bull markets like we are in now. We typically see this piece funded at the 5 to 15% level from equities. Dynamic high income, as well as Dave mentioned, we didn't talk a ton about income today, but this is your ag plus, right? For your ag anchor, this is your plus, this is your spice. This is to maximize yield and diversification with built-in volatility management. So you have 3 simple options really to invest in all these models. For those that custody on Schwab, we are on the Schwab model marketplace. The simplest way to access there is to search VanEck. And we are effectively on all of the major turnkey asset manager platforms, or TAMPs. We've onboarded at just about every single one. So depending on your relationship with various TAMPs, you can find us there as well. And we also offer subsidized access to those that don't have a TAMP relationship, which we're happy to discuss in more detail. The easiest way, the easiest next step, again, is to go on to vaneck.com/model-portfolio, subscribe to the insights that you heard from the team today, and certainly reach out to your VanEck representative or contact us directly if you'd like to chat more about how to subscribe and, of course, how to allocate to any of the models you heard about today. We really appreciate everybody's time, attention, and great questions, and we'll wrap it there and wish everybody a great rest of your week.
Thanks, Pat. And thanks, David and Charlie. Didn't get to all the questions because they kept on coming in, but we're going to save some for next time. And thank you for your time and attention. Have a great day.